Hi there, everyone, and welcome to this month's edition of On Track. I'm Rob McGregor. It's the 26th of August as I record this, and we've got news right up to date and all the performance numbers up to the end of July. So, as usual, another fascinating month. General advice warning, firstly, that just means for those of you that are the clients of McGregor Wealth, this is designed for you, particularly those that invest using our CARE methodology. For everyone else, please don't act on anything that you hear in this before seeking advice that's particular to your own circumstances. So let's jump in. We're going to go through all the economic news, put into context. Lots to talk about with interest rates, the economy, all the usual stuff, but markets sort of bouncing around in a sideways band at the moment, but lots of talk about different things, which I'll jump into. So in terms of the news, interest rates, RBA is holding, but they're talking tough. They're talking about the potential to hike is still there. And that's because inflation's sticky. If we look down at the numbers in the financial markets, cash rate has now been steady for 3-4 months. 90-day bank bills are rising steadily. So that's as longer term interest rates. You can see the 10-year government bond yield in Australia is now above 5%. So that's the return you get. That's the risk-free return from investing in government bonds. That's snuck up. 90-day bank bills snuck up a little bit at 4.5%. US cash rate also on hold. The Fed also talking tough but not moving. That just means they've got a bias to hiking remaining. Part of that is they hope they won't have to, but they're trying to keep the markets on their toes and keep people on their toes in terms of less activity, less aggressive borrowing, that type of thing. Aussie dollar's been on the march. I think it might have even popped to 72 since we updated these numbers, but up about 71 cents. Good for those that are traveling. Aussie inflation. Now, this is interesting. I'm going to talk a bit about inflation today as we go through everything because it's the buzzword. There's this fear of inflation out there. Now, the RBA in Australia has a target band of 2 to 3%. And in our long-term things, we assume inflation is going to average 2.5%, but it rarely does. I'm going to talk about how that affects inflation, how it affects returns shortly. But we see that inflation's above that target. So they're hoping that the hikes that they've done are going to cause it to come back within that target. But they're fighting, the big challenge they're all fighting is that oil remains stubbornly high. You can see the chart. On the bottom left is the Brent crude oil price in US dollars. And you can see where it originally spiked. So it was cruising along at about 60 US dollars, and then it spiked with the start of the Iran war, and it got as high as 110. And then it's been up, down, depending on whether the war's won, done, on again, off again, and it's almost impossible to tell what's happening. I hear on the news today, Oman and Iran talking, and I think the solution will have to come out of the Middle East. I don't think Iran wants to do any real deals with the US except get them out of the way. And Iran now has control, or appears to have control, of the Strait of Hormuz, which is where all the oil tankers go in. Now, the world's an adaptable place. So people are already working out how to move oil around elsewhere. And we saw the oil price drop down to about 70 when it looked like the war was over, but then it's spiked back up and now it's kind of stuck at about 85, 90. Now, the biggest worry for that is it leads to inflation. Oil goes into nearly all transport costs, which pushes up the costs of nearly all goods. So that was the worry. But it's lingering, not amazingly high. This isn't 80s or 90s type double-digit inflation. This is inflation just over the band. Nobody wants it. I'm going to talk about whether inflation's good or bad for investors in a minute. But the same in the US. It's stuck just above that 3%. So it's not catastrophic. And if we put our lens back to the 1890s, we'd say, wow, 3% is amazing compared to 5, 10, 15, but it's still not where they want it to be. So we'll continue to see this pattern of talking tough, threatening hikes, but hoping that oil drops and takes the problem away. Mortgage rates still reflect the same levels, not much change there, although a few people, Macquarie's chasing business. You can see Macquarie's been very aggressive in the mortgage market. They tend to lend to the higher end of the market, so they like big loans with lower loan to valuation ratios. So their best rate's about 6.04%, and you can see they're paying 5.15 on a term deposit. So they're able to operate because they don't have bank branches at much thinner margins than the big banks. So they're being very aggressive, and their march into the mortgage market over the last 20 years has been phenomenal, where they're now a genuine competitor to the big four banks. So let's have a look at returns to the end of July. Excuse my typo. It's funny you read these things a million times, but so 1 year returns sitting almost on our exact targets when you look at it. So high growth at 8.67, which is about inflation plus 6, growth at 7.8, balanced at 6.4. So they're all sitting at about the longer term targets, as are the 10 years, slightly over. We've had lower inflation over the 10 years, so returns above the targets, and all sitting comfortably where we'd like them to be. We've left the dial in our market view at a 9, which is fair to expensive, just slightly over fair. And that's partly because profits are rising, things are going well, but markets are slightly over valuation, but that can be based on reasonable grounds. We've seen in the last year, earnings per share in the US rose 48% last year. Now it's a bit of a interesting number, because half of that growth roughly came from Amazon and Google, who mark to market. That means they recognize the profits on their investments in OpenAI and Anthropic, which is Claude and ChatGPT in terms of AI. So they effectively mark that to market, which means it shows up in their earnings. Now they're required to do that via the accounting standards, but it's not really a sustainable profit. And if it ever reversed, which there's certainly a selection of people that say there's a bit of a bubble in that right at that pointy end of the AI world. So if that ever reversed, that would be damaging to their profit announcements at that point for Google and Amazon. But yeah, the rest of the market moving solidly. So we're comfortable, but wary of the AI end. And I'll talk about that a bit more. So just looking back at that 20 years, which very clearly shows our pattern. It's interesting, the GFC is almost dropping off the 20-year chart. We'll start to see some interesting 20-year returns as that drops off, just on the start point and end point variations. But, 7 or 8 downturns of more than sort of 12% since that GFC. They're normal. We go through these valleys of fears. And yeah, as the market does its beautiful, boring wall of worry increase. So good, solid returns over that period of time. So let's ask the question. There's lots of noise about inflation and higher interest rates. And when you hear it from the press, it's always bad. And it's not great, but there's good and bad. So I thought I'd pose the question, should long-term investors be scared of inflation and higher interest rates? And the answer is, well, yes, but no as well. And the answer, a good answer always is, it depends. You won't hear this nuanced conversation from the media, which is why we like to have these conversations here to put things in perspective. So let's go through the bad, but also the shadow, and the good, or the thing that makes it less bad. So the first bad is, yeah, higher inflation will generally lead to higher interest rates. When we get inflation, the Reserve Bank, excuse me, or the Federal Reserve and other federal reserves around the world tend to put up interest rates to slow down the economy, to slow down inflation. That's the only tool they've got. It's a blunt tool. It tends to also lead to a slowdown in the economy, sometimes a recession, but that's all they've got, except cross the fingers and hope and talk tough, which they're doing a bit of that at the moment. So that's the bad, higher interest rates. But the interesting thing about higher interest rates or higher inflation is it deflates the value of debt. So what I mean by that, if you borrow $1 million and you buy a property or a share portfolio, and we run through a high inflation period, you don't have to pay back the inflation adjusted amount. You pay back just the principal, which stays in the dollars that you bought it in. So if you borrow $1 million, but you managed to hang on to that loan over 10 years, and we had rampant inflation, and rampant inflation will generally push up the price of assets in the longer run, can mess with them in the short run. And I'll show you examples of this in a minute, but it means the debt is deflated down. The biggest debt in the biggest government debts before this period in the world's history was post World War II. And yeah, people occasionally say we've never had debts these high, and not quite true. We have had debt government debt this high post World War II. How did they get rid of that debt? Part of it was inflation. So inflation actually helped because the debt they were paying back was covered by rising taxes that came from rising growth. So yeah, one of the benefits is borrowers who can hang in there during periods of higher interest rates and inflation tend to make good money off their investments, and their debt stays in the old dollars. Picture if you borrowed 15 years ago to buy a basic house for $400,000. Now, the fact that the debt, even if you were interest only, and the debt 15 years ago it was 400, it's still now 400, but the prices have gone up potentially in some areas to $1 million. So that gain, that borrowing has given you an advantage. So the next bad is higher prices hurt those on fixed income. So people that don't have the ability to put their income up, and it does, but for investors, it can mean companies have higher profits. So think about companies will put prices up. Now, the profit goes up in nominal terms. So nominal terms just means without taking into account inflation. But if you take into account inflation, they're not necessarily going, but the value actually goes up. So if you've got a share of real estate, which is a great hedge against inflation, as we talked about, it tends to go up, partly because rents are going up, and the same with companies to a degree, but different companies are hit differently. Some companies that have the ability to put their prices up survive inflation just fine and prosper, and the numbers go up, even if they're not real increases, just nominal increases. Other companies that are very in a highly competitive market have trouble pushing their prices up, so that makes it tougher for them. So the third bad about inflation is higher wages. Means it costs employers more, and that's bad for them, but it's good for people that don't have high debt. So the wages going up for people that don't have debt or high debt, so there's people later in their career, it tends to be. So it's obviously tougher for younger people that are having higher debt. But once again, if they hang on long enough, inflation will solve their problem to some degree by pushing up asset prices. But for those that don't have high debt, they just get wage rises. Now they've got to spend a bit more, but yeah, it's a benefit, albeit not a huge one. So the next bad is higher interest rates can push asset prices down in the short run. So when we hear about that, and that's because property, shares, government bonds, anything that we buy as assets is kind of valued based on the risk-free rate, which is 10-year government bond rates. So as that rate goes up, it leads to values going down. But the flip side is it will push the nominal asset values up in the longer term as prices and rents go up. So as prices go up, like we talked about with the real estate example, rents go up, real estate goes up, debt stays stable. So for investors, it's not a bad time. Now, the last bad that I've got on the list, not saying there's not more, higher interest rates hurt those that have borrowed a lot. Absolutely. So this is the toughest bit. When we get these higher interest rates, the reason we get a recession is people that are pushed to the limit go broke. They have to sell their property. They close their businesses. But it's only those that are pushed to the brink. For those that can survive it, yeah, they get rewarded as some of the ways we've talked about. But also, if you're retired and you've got some money in term deposits or interest-based investments, you're getting a pay rise. So picture interest rates at the heart of just post-COVID, down to 1%. Not very good for people trying to live off term deposits. But all of a sudden, those term deposits are back up to high 4s, nearly 5%. So a much better return. Still not as good as you can get with real assets, property shares, but still pretty solid. So when you hear that short-term media news that inflation interest is bad, it's bad for some, but it's also good for others. So it's way more nuanced than just a simple inflation is bad. For some people, inflation's awesome. So people that have got good earnings capacity, steady jobs, and they've got debt, and they've bought property or shares, inflation in the longer term is a great way to make wealth. And let me show you why. So here's our index chart, which you see when you come in the office or when we're doing our meetings online, that shows the line that I've covered with the green and the red is the Australian share market. And you can see this is a log chart. So it shows the value of time in the same way. So each vertical line is another double of the market. So a 10x, I should say. So it shows steady growth. Now you'll see down the bottom, I've circled interest rates and inflation, the jump that we saw through the 70s into the 80s. Now that was the highest period of inflation in Australia, and with interest rates, at nearly 15%, inflation at 10%, and it was sticky. It stuck. Now you might say that's bad, and for some people it is. If you couldn't afford your interest rates, it's very, very bad, and that's why there's a lot of volatility here. But if you look at the red line up the top, that shows from after the initial shock, the oil shock in the 70s that caused share markets to drop. They had a boom before that as well, but share markets dropped as inflation started, but then they took off. And from the bottom in 1974 to the top in 87, share market averaged 19% per annum. So phenomenal returns. So for those that were able to stick with their strategy, they got rewarded. Property prices also went up phenomenally during that period as well. So long-term investors did very well. Now, this is why we also measure your return targets as inflation plus. So when we say we think the share market's going to return inflation plus 6, it's based on, that's conservative, it's based on this. So during that period where share markets returned 18%, inflation was about 10%. So it was adjusted accordingly. Now in lower periods, share markets will have lower returns, but inflation is lower. So the nominal returns are fairly consistent through the cycle. They'll be higher and lower at different points in the cycle, but through the cycle, fairly consistent. So hopefully that gives us an insight. In terms of our exciting life, boring money segment, what to watch, there's an amazing number of deep scams. I feel sorry for public figures like, Alan Kohler, whose videos and fake, so these deep fakes, so these are things that look like someone, they sound like someone, they're talking about something, but it's not actually them. It's the scammers using them to promote dodgy investments, and there's more and more of those around. So, I mean, generally, don't click on anything that looks too good to be true. That just looks, and just avoid most things online. And certainly that's not an issue for most of our clients, but we hear of scams, people falling victims to scams all the time. And it's usually chasing things that look too good to be true, falling victim to heavy sales tactics. And it just never goes away. The techniques change over the years. Now they're using AI and deep fakes, but the techniques never change. So let's look at interest rates. The charts on the left show the yield curve. So that's interest rates at different times. So in the bottom one, sorry, let me take the top one first, which is the US yield curve. So on the right, 30-year bonds, which they have in America, you can get 5.5% for. Now, if you bought those now and inflation dropped, that would be a very good investment. You get a bit of a capital gain and a steady yield of 5%. But if inflation kept going up, they wouldn't be such a good investment. You'd only be getting 5%, while interest rates might be 6 or 7, and you'd have a capital loss as well. But you can see the green line shows that that the yield curve is higher pretty much across the board for the last 12 months. So it's at its highest level in Australia as well. Australia's got rates above 5%. The US touched on 5% briefly, but back in the high 4s. But these are higher rates. That puts borrowing costs up. That puts pressure on valuations in the short term. And we're seeing that in share market returns, which I'll talk about. At the start of the year, we looked at the headwinds and tailwinds in the market. Pretty much all the tailwinds have come to fruition except for lower interest rates. That's the one that's gone the other way. But if I walk through those, once again, we've got good global growth happening at the moment. And that's good for companies as they operate around the world. And good for companies is shares, so good for shares. The AI and CapEx, the data centers, the chips, the hardware around AI, that super cycle there's trillions of dollars being spent in that, and that remains an economic growth engine. It remains a concern for some people about whether there's too much spending going on, and nearly every technological revolution, right back to the railroads, the 1890s, doesn't always mean the people that create the revolution make the money. So nearly every railroad company, despite going a roller coaster in the share market back in the 1890s, they nearly all went broke. Now the railroads still exist, but not owned by the same companies. So at the moment, there's this frenzy of building the infrastructure the large language models, the data centers, the chips, and massive amounts of money being spent, often between the top group of companies. So, they're all paying NVIDIA, literally billions of dollars for the chips. The money goes round and round. So will they survive? Don't know. Right now, they're making lots of money. It depends how that transfers into profits. There's plenty of bears saying that that will not survive. That may be true, but the benefit of it will eventually flow to all companies, just like the benefit of the internet and the dot-com boom eventually flowed to all consumers and companies. But it might be a wild ride. I'll talk more about that in a minute. So, yeah, monetary policy is the tailwind that went the other way, all due to the Iran war. Iran war, petrol prices up, higher interest rates. Had that not happened, it would have been we would have been booming along. I suspect the share market would be 5 to 10% higher had it not been for that war. Now, I don't like the war, but I don't mind markets pulling back. It makes them more sustainable in the near term and less likely to have a big crash. And at the moment, they're showing decent returns, which I'll get to. Government spending has supported growth. Now, that's a good and a bad thing. It's a good thing for the economy. It's a bad thing for government debt and some of the other things around there. Households are generally in good shape. So we're not seeing defaults in banks. People aren't there's not a high bad debt level on mortgages across Australia and the world pretty much. That can change if rates were higher for longer, but at the moment, not an issue. And emerging markets are actually doing really, really well and have been a great bit. So those things have all come out except for inflation. So when we look at the headwinds, elevated valuations for that top end of town. It's not just the Mag 7 because it's private companies like Anthropic and OpenAI, that's Claude and ChatGPT, but it's more than the Mag 7 now. But yeah, the valuations are elevated. They're spending and making billions. It's whether they're spending too much and whether those profits are sustainable relative to their valuations that we won't get to know until the party ends, which could be never, could be 3 years, could be 1 year, we don't know. And that's mainly focused at the top end of town. So we're not worried about the valuations of more regular companies. It's just the valuations of the tech companies, particularly around AI. We were worried about sticky inflation. That's proven to be the case. So that has been sticky. That's a continued worry. So my color codes here, the yellow is it's still there, but it hasn't crystallized. So we're still worried about it, but nothing's happened. The red means it's absolutely crystallized, sticky inflation. Trade and tariff tensions are back. The US is fighting with Canada, their best friend and neighbor. Just seems crazy. They can't win the war in Iran. So off they go, we'll pick a fight with Canada. And I don't want to dive into politics. It's depressing. But yeah, that tension's still around, and the geopolitical noise, read Iran, read Ukraine, Russia, is absolutely in play. The private credit, non-bank leverage is there. There's little bits of that starting to bubble to the surface. There's failures there, not in any mass thing at the moment, but that headwind is still there and potentially. And then the black swans. Black swans are the events that hit you by surprise for some and can be the things that bring the market back. Obviously, the AI boom and bubble burst, it hasn't. Will it at some stage? Probably. Will that be years away or months away? Who knows? And as I said, I'll talk about the antidote to all this in a minute. Central banks forced back into rate hikes. They were, so that's come about. That's a tick. Sovereign debt crisis we have not had in any major economy, so that sits there. If we had a debt crisis, whether that be in particularly the ones most vulnerable, the yen or US dollar, that would cause chaos in global financial markets and volatility. Systematic stress in the private and shadow banking is there, but not in abundance. And we've had the Iran geopolitical event. It didn't do much for markets except related to the oil inflation. And there's a white swan that I've got down the bottom in the aqua color, which is if we get no black swans and you get all the tailwinds coming, it's actually a shock to the upside and markets could run hot. So all things still possible. The only antidote always to that is to maintain diversification and avoid single themes. We don't go betting on AI changing the world. We know it will, but we know it's going to benefit all companies, so we stay massively diversified. Keep some powder dry for opportunities and liquidity, so that means markets dip, that you've got power up the sleeves, and that's what our clients have with their reserves and other techniques, which I'll talk about as usual at the end, and maintaining a long-term focus. Now, long-term focus, but with short to mid-term awareness. That means so we can navigate this is why we make an estimate of the value of the market, so that we can adjust our short to mid-term tactics to keep us focused on our long-term goals and long-term strategy. So yeah, market at 9. I won't go into that anymore. In the most investors mess it up page, I've actually highlighted the result rather than the causes. All the causes still stand. They're all in action every day at the moment. But the result of this is that investors, for the most part, on average, earn less than their investments. So this is a study from Delba that's been going on for well over 30 years. I first became aware of it about 20 years ago, and the results have never changed. So when we look back at the 30-year returns, if someone had just put their money into an S&P index fund, they would average 10.15%. In this period of the study, which is 20 years, they averaged 8% instead. So 2% lost, not through the markets, but through their behavior. So that's panicking when markets are down. It's getting excited and focused on the wrong areas when markets are up. And this is the average. Now, take yourselves, our clients as an example. You don't do this. So for everyone that's not doing it, that means there's lots of people doing it worse than the average. So in other words, you guys are above average. You're getting market returns and just sometimes just over that. So even though the average is 2% below, the worst case is 4% or 5% below market returns. And that never changes. I keep thinking society is going to one day get smarter around that, but it doesn't change because it's human behavior that drives those things. One of those behavioral biases, a new one at least for me talking to you guys about, it's always been around, is the money illusion bias. The money illusion bias is just where people have a tendency to view their wealth in nominal terms. So that means without thinking about inflation. As I've talked about earlier, nominal just means I've got $100. Next year I've got $100. I think I'm doing okay. But we don't think about the real value. If inflation went up 5% in the last year, I need 105 just to buy what 100 bought. So my wealth has actually gone down, but I don't think that way. That's the money illusion. Same with pay rises. Someone gets a pay rise of 3%. They think this is awesome. But if inflation went up 5%, they're actually worse off in real purchasing power. And it's even worse in Australia because we have a progressive tax system, so that pay increase can put people into higher tax brackets, or it's all taxed at the top rate that they're on. So they're actually, after tax and after inflation, they can be worse off. And certainly that's what people are feeling. 6 years of no productivity growth in Australia means people who are on inflation adjusted wages are feeling worse off, and that's because they are. In the 4 pillars, I've focused on the beautiful, boring stuff here today again. While all this volatility, while all the craziness goes on, there's nothing that solves it better than just the right asset allocation for your long term. That just means how much you've got in shares, how much you've got in the defensive assets, then massive diversification, so that as one thing goes up, there's usually something else going, or one thing goes down, there's usually something else going up. And we've seen that this year with rises in emerging markets and small companies, while other things have slowed down, like gold. I'll talk about that in a minute. And rebalancing. We love rebalancing every month as an investment committee. When we're towards the end of our meeting, we go through the portfolios and we look for opportunities to rebalance. So that happens when something's gone up and something else has gone down. So we sell a little bit of the thing that's gone up and buy a little bit of the thing that's gone down. And usually within a period of time, that reverses. So we switch it. And that's a profit that's over and above what the market does. The best example is in COVID. The share market dropped 36%. So if you had a 50-50 portfolio and you had $50 in shares, $50 in bonds, when the share market went down, you've then got, say, $40 in shares and $50 in bonds. So you sell some of the bonds, you buy some of the shares to get you back to 50-50. And then, of course, the share market goes up, you make a profit on that, you sell that. So even though the share market might have gone sideways over 6 months, The rebalancing means there was a profit made, and it's a free lunch, and it's something we do as a core part of our process as often as the opportunities present, because it adds value and it helps cover costs of investing. So let's have a look at the market, and I'll do a bit of a slow-mo here. But so this is the Aussie market. When you look at the last 12 months, it's been very choppy. It's gone up slightly. So the Aussie market for the year is 6%. Now, most of that's dividends. We've only had a little amount of growth increase there. And this is to July, but if you look at the 3 years, 10%, 5 years, 7.5%, 10 years, 9.36%, right on the long-term averages. Yeah. And so fairly solid. What was the downturn? Yeah, well, part of that downturn was, of course, Iraq war, energy prices, and then, different reasons for those little downturns. They're not huge, but the market's kind of going sideways at the moment while it waits to see how interest rates, inflation, and potential tech overspend is all going to play out. If it gets confidence on those things, the markets will go up strongly. If it persists, the markets will go sideways. And if it got worse, they may drop. We don't think there's a high probability of markets dropping more than a 10 or 15%. There's always the possibility of a 10 or 15% downturn. That's part of the nature of the markets. There's not a high probability. It doesn't mean it can't happen. Going into COVID, there wasn't a high probability of a downturn of more than 20%, but that was an own goal. But most of the downturns of more than 20% happen when we've had a boom. And besides that real pointy end of tech, that's not quite where most of the markets around the world are. US shares up for the year, so 17%, so rock solid. The downturn during the early bits of the Iraq war there as well. But a good steady year with the dip in the middle. And you can see at the top, on the bottom left-hand corner, and I'll read these out, but the top US shares is NVIDIA, the chip maker, heavily involved, the driver of AI and the main beneficiary. Apple got a bit in AI, but not as heavy as some of their competitors. Microsoft, similar to Apple. Amazon, heavy into AI, particularly around the data server. People host the large language models on. Alphabet, Broadcom, another chip maker, Alphabet, which is Google. Very heavy into that, as is Facebook, Tesla, etc. So very tech heavy at the top end. And they've had a solid year. But we're starting to see some of that turn to other companies, smaller companies, mainstream as well, which I'll talk about in a minute. Global leaders, quite similar. It's the same companies at the top here. So except you add in some of the overseas one like Samsung, and that's had a good year, also about 20%. US small caps has been the massive turnaround. The previous, it was going through a flat period, and particularly in the last 6 months, a nice increase in US small caps. So this is the more broader market rather than just the tech guys. You won't know the names of the top ones here. You might, but most, including me, don't. They're smaller companies. There's literally thousands of them in the US. And that's where the economic engine is, and it's been a very good year. So this and emerging markets, which I'm on now, is a great poster child for diversification. So your emerging markets up until 2 years ago was very low returns. I think we had 4 or 5% is about the 5-year returns, and you can see in the last year up 35%. That's pushed up the 3-year and the 5-year return. So once again, perfect example of why diversification matters and the power of rebalancing. So at the moment, we're rebalancing by selling some of the emerging markets and buying things like Australian shares that haven't had as good of a year. That will invariably switch around, and once again, which provides that benefit. Gold, which was on a tear. Gold got to as high as 60% one-year returns, but you can see from a high for GOLD in Australia, which is the ETF that we invest through, or one of the ETFs we invest through, was just over 70, and then at the peak it dropped, right down to about 55-ish. The tables have turned. It looks like it's trending back up again, but a lot of that was profit taking coming out of the market. As investors took profits from gold's wonderful run. We still think gold is a really important part of the portfolio. Let's jump into the property world, and you can see the rolling returns across all cities. So that just means, so right now, the last 12 months returns, we've got 21% in Perth, we've got 17% in Brisbane, 13% in Adelaide, 10% in Hobart, 3.8% in Sydney, 1.9% in Melbourne. Now you've heard on the news that property prices are going down. They started off going down in Sydney and Melbourne. Now that's been joined. So in the last month, you'll see it's down across the board. Not huge numbers, but going down. Some in the media try and extrapolate those and say they're going down at a rate of 12% per annum, which is just stretching the truth a little. They've gone down in 1% in a month. And yes, if you extrapolate it, that's 12%, but it's not actually what's happened. The markets have not dropped 12%. And as I said, 12 months still solid, but there's pressure there. But here's what I find really interesting. The data across different, if you split the market into the bottom 25%, which is the first home buyer market, the middle 50%, which is the everyday, and then the upper 25%, which is the more expensive property, you'll see quite different results. So the orange, and we've got from left to right, Sydney, Melbourne, Brisbane, Adelaide, Perth, Hobart, Darwin, ACT. So the one thing that's in common here is the damage in the last 3 months, which is pretty much since the budget announcements and interest rate rises, has occurred more at the top end. So top end in Sydney is down 5%. And I know from talking to my clients in Sydney, the top end in lots of places, not everywhere, but certainly places like the eastern suburbs, is down that 5%. We're having some cases of down up to 10%. So it's very particular to locations and regions. But here's the interesting, the orange, which is the first homebuyer territory, ignore Darwin and Hobart because they're smaller cities and run out of cycle. But everywhere else, it's hardly been impacted at all. So this means all those budget changes, which supposedly helping young people get into property, hasn't changed the entry-level prices of property. So it's changed the top end. So it's caused people with higher value properties to lose some money, but not, it hasn't made entry-level properties any easier. Now, the government won't come out and say they want prices to drop, but that's the only way you make it more achievable for young people. And the only way to do it eventually is to help lift all incomes. And we see time and time again in our own clients' families, in our clients, in our own families, plenty of examples of young people getting into property. Yes, it's hard, but as my older clients, and I also resonate with this, remember, it was never easy. We just looked at interest rates back at 14% in the 80s. So it's always been hard. It feels harder, but that's partly the narrative in the media. And there's a few things that are harder. Prices are certainly high, and I'm trying to diminish how hard it is to get in. But I've had the pleasure of watching my kids and others get into the market just by hard work. And there's plenty of good stories out there, as well as the hard luck stories. One of the reasons property has stayed steady is rental rates are still going up. So once again, think about the inflation story I told before. Inflation higher, guess what? Rents are higher across the board, 6% rents up in the last 12 months. So that naturally puts a floor on what property, as an investor, I go, wow, that's a good market. I want to stay in that. So that causes prices to drop less than they otherwise would. Keep in mind, this is the average. And once again, rents tend to be a higher yield on lower value properties, which is the first home buyer. And that's where the competition is, and rents going up. That also increases, also increases the motivation of people that are renting to go and buy, because they can often buy at closer to, the mortgage rate, or the mortgage payments will be closer to the rental just because the rents are going up so much. Home loan rates, no real changes of any significance there, some minor changes, but it's pretty flat too. So when you look through the variable rate, and generally most of what we're seeing, in the low sixes is the average, and then across the fixed rates, we've got, not much difference from the 1 year at 6.4 to the 5 years at about 6.7. So very flat. NAB's actually flat right across the curve there. So that means there's no prediction from the banks of rates going neither up or down. So they're predicting effectively a flat market. If they thought rates were going down, they may offer lower rates on the fixed, longer term fixed rates. Our charts from performance property, houses on the left, units on the right. Performance property have adjusted their methodology or evolved it to show the blue properties are what we'd call smooth markets, So that's like Sydney, Melbourne, and if you think of those as blue chip markets, and the red properties are more workforce related. So think mining and tourism in Australia. So they're more dependent on what's happening in the workforce. If there's people making lots of money and more jobs being created in mining, those mining towns do well, and the reverse is the case as well. So that's the colour of the properties, and then the green, orange, red is just where those properties are, where those places are in the property clock. So at the bottom of the ladder, at the value section is Melbourne, and we're starting to see performance property recommend properties in Melbourne for our clients, and it seems very cheap. The median price of Melbourne is roughly half of the median price of Sydney. I've never seen that in my lifetime. Now, there's reasons for that. Melbourne's done it tougher economically. Melbourne's been there before, though. They were certainly there in the 80s, and when the economics got cleaned up, property markets boomed. The demographic growth is showing Melbourne will take over from Sydney as the largest city, but Melbourne's got the ability to sprawl. Sydney's capped by mountains, the sea, so it can't sprawl as much. Melbourne can kind of sprawl all the way to Bendigo if it wants to. And so that may limit growth to some bit, but yeah, looking like a value market there at the top of the clock. So, which is if you were going to sell, and just because a place is at the top of the property clock doesn't mean you sell. This is just one cycle. As those of you that have owned property for many years know, one cycle's good, two's amazing, and three is just extraordinary. So holding through the whole cycle will suit some people, but we know for lots of our clients who are either retired or retiring soon, you're looking for a window to sell. So this is useful for those that are coming into that window, and you can see Brisbane, Adelaide, Gold Coast, Sunshine Coast at that selling window, and then places around New South Wales and particularly Sydney are in that correction phase where they're coming down. This is just a model. It's not a prediction. It's not a framework that's perfect, but these guys at Performance Priority have great research data. I'm overdue to do another webinar with them, which I'll do shortly. But yeah, we do rate their data highly, and it helps give us a picture of, in other words, if I'm buying for investment right now, I'd probably err towards Melbourne rather than the Sunshine Coast. Now, that doesn't mean I wouldn't do well on the Sunshine Coast, but it means I might have to endure 3 to 5 to 10 years of stagnant prices before I get a big increase. Will Sunshine Coast perform strongly in the long run? Absolutely. But it's a desirable place to live. But right now it's had an amazing price run, so it will probably go slower. Melbourne's had almost no growth in the last 5 years, so it will probably catch up. I may have mentioned this last month, but I'm hearing stories of people that moved up from Melbourne during COVID to Queensland. The properties they bought at that stage have doubled, and some of them are selling up and going back to Melbourne, where they can buy the same property for half the price of the Queensland property, which is just unheard of. So that will cause prices to go up eventually. And this just shows that March, and this was the national median price, and this just shows why property is such a great investment. But there are flat periods in there, and we're likely to be heading towards a flat period at the moment on average, but there's always places that will do better than others. So just in summing up, exciting life, boring money is our mantra, and our funds remain relatively boring, but beautifully consistent in the long run. So our approach, investing is best done as part of a real financial plan. That's a plan based on you, your goals, and what's important to you. Portfolios designed to meet those goals over the long run. We take a long-term view, but we are short to mid-term aware, so we will pivot slightly to suit short to medium-term conditions, and then we apply those boring principles: diversification, asset allocation, liquidity. Low-cost index fund for most of the portfolios means we don't waste money on fees unless there's a good reason to tilt towards an active manager. We protect against short-term volatility by strategy, which is holding reserves for our retirees so they never have to sell good assets at a bad time, and dollar cost averaging for our wealth accumulators, where they're always buying. So when the market dips, they're buying as well. Rebalancing regularly, as I've talked about today. And as always, there's only 3 ways to lose money in the share market. And I'm pleased to say our clients just don't do it. One is panicking and selling when the market's down. The other is having to sell when the market's down. And the third is not being properly diversified. It's been a good year for our clients. It's been a good 10 years for our clients, actually been a good 30 years for our clients. We expect that to continue, but as always, with volatility from time to time, but with a process and portfolios that is designed to ride through that. Thank you for listening. As always, if you've got any questions you'd like me to talk about in these things or any hot topics, always happy to get that feedback. And until next time, it's Rob McGregor signing out.